Hello everyone, welcome to our session on comprehensive income and equity. This module will clarify the distinction between net income and comprehensive income, which is a often point of confusion. We will specifically focus on the components that make up other comprehensive income, or you may remember as OCI, and how they impact a company's financial statements. Let's get into it. Okay, so what are we going to cover today? First, we are going to cover the statement of comprehensive income. Basically, we're going to see the big picture, which is the net income plus other comprehensive income. Then we are going to go over the PUFI mnemonic. So you may ask, what is comprehensive income? So we have a net income. We know from our income statements, we are able to calculate. Why do we need to have something like comprehensive income? And what is this term, other comprehensive income? So basically, I think this way, we have our net income, then in the end, the dividends, etc., it goes as retained earnings to our equity. However, there are some other items, there are some gains and losses which are not related to net income, but they may still affect our equity. So basically, those items are captured in a statement called other comprehensive income. So you usually see this one below the net income. So in the books, you might see them as separately, but if you review a very detailed income statement, you will see the net income, then underneath other comprehensive income. So this statement captures all those changes. Then the combined of them becomes the comprehensive income statement, and the purpose of it, the total change in equity from non-owner sources. Okay, now let's do a couple examples what's in the other comprehensive income. Hopefully it's going to make a little bit more sense. So remember, we had our net income, then we have our other comprehensive income. That becomes our comprehensive income. So you may ask, okay, what items go to net income statement and what items go to other comprehensive income statements? Remember, I just said these items, they eventually affect the equity, but they are not related to net income. So the easiest way to remember them is the PUFI mnemonic, and you can think, okay, if an item is in this mnemonic, it goes to other comprehensive income. If it is not, it goes to net income. That could be an easy way to remember them. So what's going on here? So here the P stands for the pension adjustment. So basically they are related to changes in funded status of defined benefit plans. So we don't see them anymore, unfortunately, but there used to be a time there was pensions. And this basically calculates the changes in those plans. And what does U represent? They represent unrealized gains and losses, so specifically on available for sale debt securities or cash flow hedges. So in the questions, you would usually see them like that. F is the foreign currency items. The business may be doing a lot of business are global now. Maybe there are some changes related to currency adjustments, and eventually that affects the company's equity. So it goes to other comprehensive income. And the I stands for instrument-specific credit risks. Basically, those are the changes in fair attributable to instrument-specific credit. As I said, we're going to go more detail one by one. But for you to remember, PUFI mnemonic, if you see the other comprehensive income, we're going to look at the PUFI mnemonic. If it's a part of it, it's in the other comprehensive income. If it's not, it was in the net income. As we said, P stands for pension adjustments. What kind of adjustments? Maybe there are some actuarial gains and losses based on their investments. Maybe there are some prior service costs not recognized. Maybe there are some net transition assets or obligations. Basically, if something like that happens, we keep track of them in other comprehensive income statements until they are amortized into net income. What's the purpose of this one? If an investor wants to read income statement and the pension is losing so much money, they may want to see that before they invest in the company, even if it's not fully recognized. This basically gives that information to the readers of the financial statements. Okay, and U in the PUFO mnemonic stands for unrealized gains and losses. Here you may ask, okay, I remember that the trading securities, they go to net income, which is true. So there's a distinction here, and in the exam, they like to ask that distinction. So if there's an unrealized gain on trading securities or equity securities, they directly go to net income. There's no issue here. What we are talking here is maybe less common ones, what they could be. So maybe available for sale debt securities. So if the company has unrealized gains and losses from those securities, we report them on other comprehensive income. Or if the company has a cash flow hedges, like sometimes companies buy this as an insurance. So the effective portion of those gain or loss are reported in other comprehensive income. But watch out again, I'm repeating, if there's a unrealized gain or loss on trading securities or equity securities, they go to net income as before. Okay, so following the unrealized gains, we go to F in PUFI mnemonic, which is the foreign currency items. So when a foreign subsidiary's financial statements are translated into parent company's reporting currency, the resulting gains and losses are something we call translation adjustments. Okay, what I mean by that, so let's say we have a company A, and then this company A operates in country B and country C, and in the end, they have their sales and losses, then it goes back to the main company's financial statements, but maybe company B is in the Eurozone, maybe company C is in Australian dollar. So those changes is called translation adjustments, and those ones are reported in other comprehensive income. So in that case, we calculate everything and we know that there are some changes because of the foreign currency adjustments. It goes to other comprehensive income, then they go to equity. However, there's an exception here. So let's say in this example, maybe the country B, country C, they are not like a subsidiary, they're an integrated part. They're integrated part. They are together. So if it's like that, or the second option, if they are working in a hyperinflationary situation, I think lately, unfortunately, we had in Venezuela. So when the situation is like that, there's an exception and we report them on the net income, not in the other comprehensive income. And the reason behind that is being maybe more conservative and giving better information to the readers of the financial statements. Because if you are going to invest in a company and they are in a company where there's a hyperinflation or they are so connected to that company, of course you would want to know the foreign currency translations in the net income because it would give you better information. Okay, and we are in the last portion of the PUFI mnemonic, which is I, instrument-specific credit risk. So what I mean by that, so this one specifically applies to liabilities, where the fair value option is elected. And this one also has two versions, depending the type of risk. It can go to net income, or it can go to other comprehensive income. Okay, so what's going on here? Sometimes, almost always, companies have some liabilities. They got some debt, and based on it, they pay some interest rates. And that interest rate, how much we are paying as an interest rate, depends the market conditions and our credit worthiness. A brand new company is paying much higher interest rates than Apple or Microsoft, those big companies, because why? They know that they are more likely to pay their debt. Okay, each year when we have our liabilities, we need to calculate the changes and how they are going to affect our equity. So, if the change is based on the base market risk, so what I mean by that, the interest rates increased or dropped, so based on it, how much we owe increased or how much, or decreased basically. So if that happens, it goes to net income. It's straightforward. You may remember, you calculate the interest expense and the differences, it goes to net income. However, if there are changes, they are based on the company's credit risk, then that goes to other comprehensive income. So what I mean by that, maybe company was in a very good situation. I can give an example. Before the AI boom, I remember there were some websites that could find the information. You would pay them money. I think there were some websites they would even do your homework, and you would pay money for them, and they were very profitable. So that time, those companies, they were more creditworthy because a bank would tell them, okay, yeah, your business makes sense. So, you're high creditworthy. But then the changes happen and their business is not as profitable. Their creditworthiness change. So in that case, that would go to other comprehensive income. That's not related to outside, that is related to what is going on inside the company. You can think it that way. So we are done with the PUFI mnemonic. We know what are the items that make up the other comprehensive income. And after the items are in the other comprehensive income, they transfer to accumulated other comprehensive income where they're being accumulated. So what happens if the item is realized? Basically, maybe there was an asset there and the company sold that. When that happens, in order to avoid the double counting, we move the items to net income and we deduct them from the other comprehensive income. The whole purpose of it is to avoid the double counting. Okay, so we covered the reclassification adjustments. Now let's go over how we can report them. This one is very straightforward. We have two options. The first option is the single statement. We have one continuous statement. It starts from the revenues, and then we add the other comprehensive income items. Then in the end, we reach the total comprehensive income. The second option is the two statements option. This one you may be more familiar from the textbook. So basically we have the traditional income statement. And the second one, we have another statement called statement of comprehensive income. Here usually the first item is the net income, then we add the other comprehensive income items. Then in the end, we have the same numbers. It is just a preference. Okay, now let's talk about something called accumulated other comprehensive income. At this point, everyone thinks, what are those terms? What are the differences? Because they all sound the same. So the first one, remember that we had the other comprehensive income, which was like a net income plus other comprehensive income. Then we would reach the comprehensive income statement. Basically, the numbers here, they transfer into the balance sheet in the equity section, and you can think it as like a holding tank. Yeah, that's, I think, the best way to explain it. So all those items, they stay in this section. That's a line item in the equity section, and they stay there until we use them. So once we start use them, we deduct them and we move them into net income. When you look at this item on the equity section, you can see them, okay, those are the items, they've been accumulated and they are affecting equity, but they are not related to net income. But eventually they are going to affect the net income. So I think that's what a sophisticated financial statements reader would think of. Okay, so building on our understanding of accumulated other comprehensive income, the statement of change in equity brings all the pieces together. So basically, this statement shows how each component of equity changes over a period. So you'll see like a common stock, additional paid-in capital, retained earnings, and accumulated OCI. They're all listed here. And to have net income increases affect retained earnings. If there's a dividends declared, it of course reduces the retained earnings. So this statement is key to understand the full impact of companies' activities on the ownership structure. Now let's go over some common exam traps. So number one in the question, make sure you read it carefully because sometimes they're asking net income, sometimes they're asking comprehensive income. Depending of it, we need to remember the profile mnemonic. Where are we putting the values or items? Trading securities, if it's investment, net income, remember. If it's available for sale securities, it goes to PUFI mnemonic. The same way for the foreign currency, if it's a subsidiary, it goes to other one. But if there's a hyperinflation or they cannot be separated, it goes to net income. The similar way in the pension, the service cost and the interest cost goes to net income. But if there's an unrecognized gain and loss, it goes to other comprehensive income statement. Okay, so let's do a practice question here. So the question is asking which of the following items component of the other comprehensive income. So let's go one by one. Unrealized gain on trading securities. So here is the word is the trading for us. Remember, if it was available for sale, that would go there, but because it's trading, it goes to net income. Foreign currency transaction gain. So there's a transaction here and there's a gain happen. That's why it goes to net income. Dividend income, it goes to statement. So unrealized gain loss on available for sale debt securities, that goes to other comprehensive income. Okay, here's another practice question. In the scenario, we have a company and they reported some amounts for year one and they're asking us the comprehensive income. Remember what was the comprehensive income? It was net income plus other comprehensive income. That gives us the comprehensive income. So we have the $100,000 net income. We have an unrealized gain from available for sale. That goes to AOCI. Unrealized loss, but here is the word is the trading. Remember, if it's a trading securities, it goes to net income. So it does not go here. It's already included in the net income. And foreign currency translation loss, that also goes to other comprehensive income. So the 100, 120 minus 10, 110, the answer is C. Okay, so we have another question here, and this time it is asking us what is the ending equity balance? Okay, so whenever we see the equity question, which is a balance sheet, maybe think of this parallel similarities between net income and other comprehensive income. So remember, we have a net income statement, and in the end, we calculate our net income. And in the balance sheet, it goes to retained earnings. That's the relationship between the income statement and the balance sheet. For the other comprehensive income, which could be the bottom portion of the income statement or its own statement, the total of the amount goes to balance sheet as other accumulated other comprehensive income. So it's almost like a parallel relationship here. So by knowing that, let's review the question again. It is telling us, okay, so at the beginning of the year, we have 2 million here. And then net income, which goes to retained earning is 500,000. But then we have a dividends declared 50,000. So we have 2.450 here. And we have an OCI item, $20,000. Remember, OCI goes as accumulated other comprehensive income in the balance sheet. So it will go there as $20,000. So in the end, you can see that our ending equity is 2470. And what is going to happen when this accumulated gain becomes realized? We are going to debit accumulated other comprehensive income and increase the net income basically to avoid the double counting. Okay, so what are the key takeaways from today's class? So the first thing, memorize PUFI. Remember, if it's not a pension, unrealized, available for sale or hedge, securities or foreign currency or instrument credit risk, it goes to net income. If it's not PUFI, it goes to net income. The second thing, keep in mind, reclassification is critical. Okay, so when you see an OCI item is realized, which you may see in the simulations, which like an example like sold, remember to move out of OCI and into the net income. Otherwise, we're going to have double counting. And the equity parallel, I just explained how the net income feeds the retained earnings, OCI feeds the accumulated OCI, and they are both part of the stockholders' equity. Perfect. Thank you, everyone. So we finished the third portion of the income statement. Now let's do some multiple choice questions.